Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Microsoft.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's unpack this. It is Monday, February 23rd, 2026.
It is indeed.
And looking at the market this week, the vibes out there are, well, they're complicated.
Complicated is a very, very diplomatic way to put it. There is definitely a mood out there right now.
Right. I mean, if you've been scrolling through the financial news feeds or, just watching the terminal, you can feel the anxiety. There's all this chatter about a sector rotation.
Yeah, the AI scare trade.
Exactly. The bears are getting really loud about this AI scare trade, basically suggesting that the smart money is fleeing big tech because the party is over.
Right.
And you look at Microsoft's chart specifically, and it's just been chopping sideways in this range between $397 and $415.
Yeah, it feels stuck.
It totally feels like it's holding its breath.
It's in a holding pattern for sure. And that anxiety is understandable. When a stock that massive stops going up, people instantly start looking for the exit door.
Exactly. So the mission for this deep dive today is pretty simple, but critical for your portfolio. We need to figure out, is the AI party actually over? Is this the beginning of a prolonged stagnation for Microsoft?
Or is the market just hyper-focused on the wrong signals?
Right, missing the forest for the trees.
It really is the classic battle of sentiment versus substance. Sentiment right now is jittery, it's reactive.
Totally.
But if we strip away the scary headlines and actually look at the hard data, specifically that Q2 FY 2026 report that just dropped, the scare narrative really starts to fall apart.
The substance tells a different story.
A completely different story.
All right, well, I am all for substance over scare tactics. So give us the reality check here. The stock is consolidating, sure, but what is actually happening under the hood is the growth engine sputtering.
Not even close. If anything, the engine is revving harder than it has in years. Yeah, just look at the top line. Revenue for the quarter hit $81.3 billion. That is up 17% year over year.
Okay, let me just pause there for a second. $81 billion.
Yep.
In a single quarter. That is roughly $320 billion a year. That's the GDP of a medium-sized country.
It's a staggering amount of money moving through the system. But here's the thing. Revenue is vanity. Profit is sanity.
Right.
The number that really should make your jaw drop, the one that completely contradicts the scare narrative, is operating income.
Okay, so this is what they actually keep after running the business, right? Before taxes and interest.
Exactly. Operating income rose 21% to $38.3 billion.
Wait, so revenue is up 17%, but income is up 21%.
Precisely. And that is the absolute key takeaway for anyone worried about bloat or inefficiency. When income grows faster than revenue, it means margins are expanding.
They aren't just selling more software.
Right. They are becoming more efficient at doing it. They are squeezing more profit out of every single dollar of sales.
Which is incredibly rare for a company of this size.
Yeah.
Usually at this scale, you see diminishing returns. You see costs spiraling just to chase that last little bit of growth.
Exactly. And remember the context here. We are in the middle of the biggest infrastructure build-out in human history. They are spending fortunes on chips, on data centers, on power.
Yeah.
Yet despite that massive spending, they are still expanding their margins. That tells you the core business is incredibly disciplined.
So we've established that the machine is efficient. But let's open up the engine room a bit, because for the last 5 years, the thesis, the reason everyone owns this stock, has been the cloud.
Yes.
Is that still the main event, or is it getting crowded?
Oh, it is absolutely still the main event, and it's accelerating. The Microsoft Cloud, which is, the broad umbrella term they use, brought in $51.5 billion in revenue.
Just from the cloud.
Just the cloud. That is a 26%.
$51 billion from the cloud segment alone. Again, the scale of that is hard to wrap your head around. That's bigger than most companies' entire annual revenue.
It's massive. But we want to get specific. We have to talk about Azure. That is the crown jewel. That's the direct competitor to Amazon's AWS and Google Cloud.
Okay, and how did Azure do?
Azure revenue specifically grew 40% year over year.
40% growth.
Yeah.
On a base that was already that huge.
On a base that was already over $75 billion annually.
Yeah.
To grow a business of that size by 40% is mathematically incredibly difficult. It basically defies the law of large number.
So why aren't the bears impressed? I mean, if Azure is growing at 40%, why is the stock stuck at $400?
Because the market is forward-looking. The market is worried about saturation. They're worried that everyone who wants the cloud already has it, and the growth is about to just fall off a cliff.
Right.
But this is where looking at the report in detail reveals the hidden value. There's a metric in there that most headlines completely ignored, but it is arguably the most critical number for you as a long-term holder.
I love the overlooked metrics. What is it?
It's called CRPO, Commercial Remaining Performance Obligation.
Okay, that sounds incredibly dry.
It really does.
Like something only an accountant would love. Break that down for us. Why should the average investor care about CRPO?
Think of it as the backlog. It represents the total value of contracts that customers have signed, legally binding agreements, but the service hasn't been delivered yet, so Microsoft hasn't billed them.
So if a big Fortune 500 company signs a 5-year deal for Azure today, the money they will pay in years 3, 4, and 5 is sitting in the CRPO bucket.
Exactly. It's money that is effectively locked in, but not yet cashed in. It gives you incredible visibility into the future.
It's like having a guaranteed paycheck for years to come.
Precisely. And in this last report, that backlog didn't just grow, it exploded. It surged 110% to hit $625 billion.
Whoa, wait, did you say 625 billion?
$625 billion.
That is insane. Let's try to visualize that. That is more than $500 billion of revenue that is already signed, sealed, and waiting to be delivered.
Yes.
So regardless of what the stock market does next week, or if there's a sector rotation, or if people get scared about AI, Microsoft has $625 billion worth of work already on the books.
That is exactly why we call it a wealth-building metric. It creates a floor. It is the ultimate defensive moat. When you have a backlog that massive, you are insulated from short-term volatility in a way that almost no other company on Earth is.
Even if the economy slows down, that revenue's coming in.
Exactly.
That is a serious safety net. But why is it growing so fast? Why is it up 110%? Are companies just panic buying cloud space?
It comes down to the moat. We talk about competitive moats a lot, but Microsoft's is getting wider because of AI. Right now, Microsoft is capturing 45% of all new cloud AI case studies.
Nearly half of all new projects.
And if you look specifically at generative AI projects, the cutting-edge large language model stuff, they're capturing 62%.
62%. So basically, if a company is trying to build something with Gen AI right now, there is a better than 50-50 chance they are doing it on Azure.
Yes. And this is the feedback loop. The stake in OpenAI, the integration of Copilot, it's all driving enterprises to lock themselves into the Azure ecosystem.
Because it's easier.
Exactly. Once you start building your AI infrastructure on Azure, integrating your proprietary data, your security protocols, your compliance, you're locked in. You aren't going to switch to a competitor 6 months later just to save a few pennies per hour.
It's just too complex.
Way too complex.
So that $625 billion backlog isn't just a number. It represents thousands of companies essentially marrying Microsoft for the next decade because the divorce would be too messy.
That is the perfect way to put it. High switching costs equal revenue durability.
But surely it's not just about the server farms, right?
Yeah.
I mean, I'm looking at my screen right now, and I've got Word open, I've got Teams open, Microsoft is everywhere. Is that legacy software just coasting, or does it actually matter to the growth thesis?
It matters immensely. You can't think of them as separate buckets anymore. This segment, productivity and business processes, hit $34.1 billion in revenue.
And that includes Office 365, LinkedIn, all the stuff we use daily.
Right. Office 365 commercial is up 17%. LinkedIn is up 11%. Now think about that. Double-digit growth for Office software in 2026.
You'd think everyone who needs Office already has it. How are they growing that fast? Are there really that many new businesses opening up?
It's not just new users, it's upselling, it's Copilot.
Right.
They are taking that massive user base of hundreds of millions of workers and selling them AI add-ons.
Wow.
But here's the fascinating thing about how this connects to the bigger picture. We shouldn't think of Microsoft as just a tech company anymore. You need to think of them as the digital operating system for global business.
The digital operating system for global business. I mean, that sounds like a marketing slogan.
It sounds like one, but is it true? Can you imagine trying to run a Fortune 500 company today without Office, without Teams, without Azure, and without Dynamics?
You basically can't. You'd be back to using carrier pigeons and abacuses.
Exactly. They are a utility. And this leads to another financial safety net that investors love. 70% of their revenue is recurring.
70%.
70%. It is subscription-based. So every month or every year, that money comes in automatically. It creates this incredible revenue durability. When you combine that with the massive backlog we talked about, you start to see why this company is such a fortress. Even if the economy crashes, businesses will fire employees before they cancel their Microsoft subscriptions.
It is the last light they turn off.
That's okay.
It's like a utility bill at this point. You pay for electricity, you pay for water, you pay for Microsoft.
Pretty much.
Okay, so we've established it's a fortress. It's safe. But investors don't just want safety. You want stock price appreciation. We want to know what is going to drive the stock price up from this $400 range.
Right.
Let's talk catalysts. What is happening right now in the news that is actually moving the needle?
Well, looking at the recent deal flow, there are some very interesting signals that the AI boom is still in the early innings. First, there's the deal with Iron.
Iron. I saw that headline. That's infrastructure, right?
Yes, it's a massive cloud infrastructure deal, multi-billion dollars. It signals that the infrastructure boom building out the actual plumbing and power for AI is still very much active.
Because there was some worry on Wall Street that maybe the spending would dry up in 2026.
Exactly. And this deal says, no, we need more power, more space, and we need it now.
Okay, so the picks and shovels phase is still going strong. What else?
Then you have things like CoStar. They are a massive player in real estate data. They are effectively betting their future on Azure and OpenAI to power their homes platform.
Oh, interesting. So applying AI to real estate listings.
Right. And this is important because it shows normie industries, real estate, healthcare, logistics, are moving from just testing AI to actually running their business on AI.
That is the transition from hype to utility.
Exactly.
And I saw something about a leadership shift in gaming. Asha Sharma.
Yes, this is a really intriguing development. Asha Sharma has taken a leadership role in the gaming division. Now, on the surface, you might just think video games, but the implication here is a gaming AI pivot.
Meaning what? Not just better graphics.
Meaning deeper AI integration into the mechanics of gaming and monetization. Think about it. It costs hundreds of millions of dollars to develop a AAA game today.
Yeah, it's like a blockbuster movie.
Right. But if AI can generate the environments, the dialogue, the textures, that development cost collapses. And it's also about monetization. Think about dynamic storylines, personalized AI characters that you pay to interact with.
So making the games cheaper to build and more addictive to play.
Exactly. Gaming is a massive market, but the margins have always been tight compared to software. If they can use AI to fix the margins, gaming goes from being a hobby to a massive profit center. It is a sleeper hit waiting to happen.
That could be huge. I mean, people spend a ridiculous amount of money on gaming. If AI makes those games more personalized, that's a direct line to profit. And looking ahead on the calendar, what should we be watching for?
We have the Q3 FY 2026 earnings coming up in late April. The analysts are expecting that 20% cloud growth trajectory to continue. If they hit that, it will be another validation that the AI scare is completely unfounded.
Okay, so April is the next big check-in. But I have to play devil's advocate for a minute here. We are smart wealth, which means we have to be realistic about risks. You've painted a very pretty picture, but the bears have a valid point about cost. This stuff is expensive.
It is incredibly expensive.
We are talking about CapEx, capital expenditures, building 2-gigawatt data centers, buying the latest Blackwell chips. We are talking about hundreds of billions of dollars.
Right.
The bear case is that Microsoft is burning cash faster than they can ever earn it back. Is there a risk they are digging a hole they can't climb out of?
It is a valid question. The CapEx constraint is the #1 risk. If they spend $50 billion on servers and no one buys the AI services, that is a disaster. It's just depreciating metal sitting in a warehouse.
Right. Are they burning cash faster than they can make it?
It is the question. But here's the answer. The financial shield.
Which is?
Free cash flow. Microsoft generates over $90 billion annually in free cash flow.
Define that for the listener who might confuse it with revenue.
Free cash flow is the cash left over after a company has paid for its operating expenses and all those massive capital expenditures. It is the real profit you can actually put in your pocket.
Wait, that $90 billion is after paying for the massive data centers.
Yes. That is the power of this model. They are self-funding the biggest industrial expansion in history, and they still have $90 billion left over.
That is a wild advantage. While competitors might be sweating over interest rates or taking on debt, Microsoft just writes a check.
Exactly. Most companies, even big ones, would have to issue junk bonds, take on massive debt, or dilute shareholders to fund this. Microsoft is doing it out of pocket.
Wow.
And not only are they funding the AI build-out, but they are also still returning money to shareholders. In Q2 alone, they returned $12.7 billion via dividends and buybacks.
So let me get this straight. They are building the most expensive infrastructure humans have ever created, and they still had enough loose change to hand $12 billion back to investors in a single quarter.
Loose change, I suppose you could call it that. But yes, it creates a heads I win, tails I win situation. Their balance sheet supports the heavy investment without squeezing their cash flow. They can outspend almost anyone, and they don't have to put the company at risk to do it.
It really puts a cost argument into perspective. It's expensive, sure, but they can afford it better than anyone else.
They can afford to be wrong for longer than anyone else can afford to stay in the game. That is the ultimate safety net.
So let's bring it all home. We've looked at the cloud growth, the absolute monster that is the $625 billion backlog, the sticky ecosystem, and the fortress balance sheet. What is the final verdict? Where does this sit on your scorecard?
I'm giving this a bullish score of 9 out of 10.
9 out of 10. That is aggressive.
It is, but the thesis supports it. If I had to give you an elevator pitch for this stock right now, I'd call Microsoft a defensive growth anchor.
Explain that phrasing. Usually, defensive stocks are boring utilities, and growth stocks are risky tech flyers. You're saying it's both.
It's the hybrid. You have the defense, that $625 billion backlog, 70% recurring revenue, and $90 billion in free cash flow protects your downside. It puts a floor under the stock.
Right.
But you also have the growth, 26% cloud growth, 40% Azure acceleration, and clear leadership in the AI revolution.
It's the best of both worlds. You get the safety of a utility company with the upside of a Silicon Valley startup.
Exactly. They are outpacing rivals like AWS and Google in AI case studies. They have 72% gross margins on that cloud revenue. The fundamentals are just pristine.
But, and this is important, what is the timeline? If you buy today at $400, are you looking to be rich next Tuesday?
No. And we need to be very clear about this. This is a multi-year hold. We are looking at holding through the AI diffusion phases of 2027, 2028, and beyond.
Want out a quick trade?
Because the stock is in a consolidation phase. It might be flat for another month. It might even dip if the Fed sneezes or if inflation ticks up. But the wealth accumulation here comes from the compounding of that backlog over the next 3 to 5 years.
It's an anchor.
Exactly. This is where you park capital you want to grow reliably, not capital you need for rent next month.
It's about patience. You park your capital here and you let that massive backlog do the heavy lifting for you.
That is the strategy.
It really is fascinating when you dig into the numbers. The headlines scream fear and rotation, but the balance sheet screams powerhouse.
And that is why we always look at the numbers, not the headlines. The headlines are designed to get clicks. The balance sheet is designed to show truth.
So here is a thought to leave you with today. We touched on the gaming AI pivot earlier. If Microsoft successfully turns its gaming division into a recurring AI-driven revenue stream similar to Office, well, does that mean your leisure time is about to become just as hyper-monetizable as your work time? It is something to seriously think about as you watch this company evolve into every corner of our lives.
That is a very profitable, if slightly dystopian, thought to end on.
We like to keep it interesting. Great analysis, as always.
Thanks.
And thank you for tuning in to Smart Wealth with Joshua. Don't forget to check your own portfolio against these metrics. We'll catch you tomorrow.